Yeah, it's always a pleasure to be here. So, Nomi, congratulations first on writing and publishing a wonderful book. And in order to write a book, especially on a topic that's so difficult, something has to inspire you to get out of bed every morning and to just trudge on and find answers that aren't so obvious. What inspired you to write this book?
First of all, before I answer that, I also want to thank the Strand, because this is my fourth book that Nancy, the Strand, and you have opened up to me, and I am particularly inspired by the entire history of the Strand. It was created before the crash in 1929. In 1927, it went through it, and it's still a fabulous independent bookstore today. So thank you. And I also, because he's not here, wanted to thank Danny McGaugh for that song. I met Danny actually in Ojai, California at a lovely wine bar called The Vine, and he was playing a bunch of songs, and one particularly inspired me as I was thinking about finishing the book, and it was You and Me, because we blame a lot of things for the plight in which we find ourselves economically, financially, the sort of feeling that it's not quite right. And this captured it in a way for me. So that was an inspiration along the way. What inspired me to write this particular book is that I was invited in the summer of 2015 to speak at the Federal Reserve, the main central bank of the central banks, that I'll be talking about in more detail, and it's in the book in many, many spots. And they do this annual conference, the Federal Reserve, the IMF, which is the International Monetary Fund, and the World Bank, and it's a closed conference. It's not a sort of glitzy one like the same bankers also do in Davos, Switzerland, or some of the bankers go to Jackson Hole, Wyoming, and so forth. It's private. It's really the regulators who get together and talk amongst themselves. And this particular summer, I was invited to address the topic, why isn't Wall Street doing enough to help Main Street? So I got invited to do this topic, and my response to the person at the Federal Reserve who invited me was like, do you know what I write about? I haven't been exactly the least critical person about the work that the strategies that you've implemented since the financial crisis, or before the financial crisis, or historically. And they're like, we know who you are. But we really want to have a conversation about this particular topic. I'm like, okay, so I show up at the Fed in the very room that the FOMC, the Federal Open Market Committee, gathers to discuss the level of the cost of money or interest rates with other central bankers from around the world. And Janet Yellen, who was the former chair of the Fed, gets up to speak, and I'm paraphrasing, but she said that everything's good now, and that the banks were fine. There were no more risks of bailouts, there were no more risks of crises, and they had basically dodged a severe bullet by their strategies. And there was a little shifting of some of the seats of some of the central banks that were not from the core countries. And there was also this feeling in me that was like, no, it's not really quite perfect. If anyone gets a blank check to write for themselves from a central bank to help them get over a crisis they created, ultimately extra money for them is going to help in some capacity, but the question is who it helps. And I got up in front of this room and I said, well, the reason that Wall Street hasn't helped Main Street, and you're asking this question, is because you didn't make them. You basically created a policy that globally was a gift, a continued gift even today, of $21 trillion. That's the size of the GDP of the United States. And you basically gifted it in different pieces to private banks throughout the world, who then used it for other things. So it shouldn't be surprising that they didn't use it for the things that you're talking about, that they didn't use it to really put into the mainstream economy in any strategic, dedicated way. That wasn't a requirement of the money they got, and so they just didn't do it. So I got inspired by the luncheon, actually, that happened after this, because I was talking to members of central banks from Mexico and from Brazil, from Lebanon, from different places, and many of them that weren't involved in the creation of these trillions of dollars for their banking systems, were concerned that they were swept up in a world now in which the creation of this money was lifting the amount of debt that was issued throughout the world, lifting stock markets in a way that wasn't sort of organic, and leaving economies such as theirs and people such as in our country behind this entire wave. It wasn't lifting everyone. It was lifting the institutions at the top, and it was lifting the individuals who had effectively caused the crisis. And so I started going around the world to examine that.
In your, I guess, journey around the world to research this book, walk us through what that was like and give us the most memorable experience, your holy crap moment where you felt, I'm really on the right research trail.
Well, I spend a lot of, I had been spending a lot of time in Mexico, just doing a lot of talks, and my dad lived there, and I just had a lot of personal as well as professional connections to Mexico. So one of the first places I happened to have been after I decided there might be a book to write here was in Monterrey, Mexico, which is it's the third largest city in Mexico, and it's sort of the industrial center of Mexico. And I was speaking at a conference there with basically all of the CEOs of all of the major companies in Mexico. And before the conference, I'm at a breakfast beforehand. Whenever you do conferences in Mexico, it's cool because they feed you a lot beforehand. You get really good coffee, and it's usually a smaller group of people that talk amongst themselves at the breakfast. And I was seated next to a senior member of the Central Bank of Mexico. At the time, he was no longer with the Central Bank of Mexico, but who had been there until the beginning of the financial crisis in 2008, and who leaned over to me and said, this was just not handled properly. It really it concerns me. It concerned me then when I left the central bank. It concerns me now. And I thought that, and he's like, and don't say who I am. So I'm not mentioning his name, and his name's not in the book, but that was sort of a moment where I'm like, okay, well, this is the beginning of something. And from there I went to Brazil, and I spent about a month in Brazil where I traveled to a number of the major cities in Brazil, and this was during the time when there was a lot of just unrest because of what was going on in the government. There was a big shift in the government. There were demonstrations in the street pro at the time the Workers' Party government that was headed by Dilma Rousseff, who is now no longer head of. It's no longer the government, and there was a lot of sort of crises that had happened over the 10-year period since the financial crisis that Brazil was navigating, and that people were in the streets demonstrating about, and that was causing political unrest, and there's also a lot of corruption there and everything else. And I wound up meeting in Brasilia, which is the capital, with one of the central bankers at the Bank of Brazil, and he sits me down, and he shows me these charts about our bank. So he's in Brazil, and this is how the impact of the United States sort of proliferates the world. And he shows me a graph of two lines. And one line is how much the Fed dumped into the markets, how much money it conjured or fabricated with which to buy bonds, which is wonkily called quantitative easing, and to keep the cost of money at zero. And the other line was how the U.S. stock market had risen. And they were basically the same line, give or take a tiny amount of distance between the two. And he said he did this on a composite basis because apparently the Central Bank of Brazil has the access to a lot of the data from a lot of the central banks and the timing, and obviously it's publicly available what stock markets do. And he did this for all the major central banks, for Europe, for Japan, and so forth. He added them together, and it was the same two lines basically on top of each other. And he said a lot of what has happened here has been trying to both keep up with and understand what's going on with respect to the outside strategies that are sort of imposed upon us and what we need domestically. And even though there's corruption and everything else at the top of the government and between the members of the different parties, the reality is there's this outside force that's beyond our country that also rocks us on a regular basis, and here are the pictures.
Now, Nomi, I've done a fair share of travel, and I do detect a distinct sense of weariness, obviously, of the political system, the financial system. If you were talking to people you've met on your travel who don't necessarily understand what quantitative easing is, how would you describe, in very basic terms, the collusion of your title? What's colluding with what, and to what effect?
Yeah, so my collusion title has nothing to do with Russia at all. There's a little bit about the Russian central bank in there, but it has nothing to do with how familiar the term is now to everyone from what's going on in Washington and with the administration. But the collusion is amongst the more major central banks. So the Fed, the Reserve in the United States, the European Central Bank in Europe, the Bank of Japan in Japan, the Bank of England in the United Kingdom, a little bit of Canada. But basically, the four major banks had to save collectively the United States financial system, right? So if we go back 10 years ago, and it is 10 years, I wrote a book about that, and I talked about it here, and I wrote a subsequent book, and along the way, nothing has changed from the standpoint of these major central banks working together and coordinating their policies to dump money into the market to keep the global level of interest rates, of money for the major countries in the world at 0%. So even though, for example, the Federal Reserve has raised rates by 25 basis points in 2015, by 75 basis points in 2016, by 75 in 2017, sorry, 2016 was only one, 3 in 2017, the rest of the world has actually gone in the opposite direction. So the moment the Federal Reserve raised rates for the first time in about 8 years in 2015 by 25 basis points, which is 0.25%, which is the smallest increment you could possibly raise rates by, it created a market like chaos in stock markets and sort of a plummeting in the beginning of 2016. The result of which was the European Central Bank said, we got this. We're going to drop rates to negative. And the Bank of Japan said, we're going to drop rates to negative, and we'll buy a whole bunch of other kinds of bonds we weren't already buying with the money that we're fabricating just to even things out. So we'll dump more money into the system. We'll find a way for it to proliferate, and we'll do this together with the Fed. So exactly what had happened in the beginning of the financial crisis happened again when the Fed was trying to maneuver its way ever so slightly out of a policy that has been in place, 0% money to the private banking industry since the end of 2008. So now all of a sudden we do have, collusion has this, and I was this morning told about the Google definition for collusion, and if it's Google, it must be right. I'm using someone else's joke, but I liked it. And what the definition basically is, it's a bunch of people that sort of do, or entities that do things in secret that are deceitful or criminal. And so with the case of the central banks, it wasn't so much secret. But what I do in the book is I actually look at a lot of the documentation, the timing of when things happen in the market place, and when certain decisions were made by these central banks, and what was said to the news and what wasn't said to the news. And so I kind of got a picture of what's happening actually quite publicly. But when it's unfolding, it sort of seems secret, because like something happens in Japan, and something happens in Europe, and something happens in Greece, and something happens in the United States, and something happens in Peru, and just all these things are happening, and you need to sort of put them together. So they were colluding because they were working together to fix the cost of money globally. Why that's deceitful is because in the process, the narrative of these central banks was that it was helping the Main Street economy. That it was basically the most massive trickle-down plan in terms of rhetoric that's ever been concocted, a $21 trillion global plan. And the idea was, as it was narrated by these central banks, the major ones, is that you put money at the top of the market, it would go to the banking system, it would get lent out to small businesses, it would get used for infrastructure, it would get used for development, it would help individuals, and everybody would be better off, the economy would be fixed. The reality is, and going back to these two charts and going and looking at the market, is that what banks and companies did is they just went on a buying spree. I mean, like if any of you are given like free money, and your choice is, go take 5 years to build a bridge, or 10 years to build a highway, or just, dump it in the market, and we'll give you more. So once you dump it in the market and it goes up a little bit, we'll basically have more on offer so it can go up even more. It's kind of a sure bet. And you've got quarterly earnings and shareholders and people to keep happy. That's what you do. So the result of which, and where the deceit is looking at the level of stock markets, and this is true of basically politicians on both sides of sort of the diaspora, whether it's liberal or whether it's conservative, and saying this is an indicator of economic health. This is an indicator of the fact that the economy is healed. Well, no, it's an indicator of money being created, being fabricated, going into a banking system that basically committed a crisis, as well as crimes along the way, and is still being legally investigated, and is still every day basically settling on large fines for what they did and doing more of it. And you have a market that looks really rosy. Not so much recently, which we can talk about, but that looked pretty good at the top. Well, 10% of Americans own 84% of the market. So the fact that it went up a lot just by math didn't really help everyone else.
Yeah. I'd like to steal that trickle-down rhetoric. That's a great phrase. And it is what we saw. And I remember vividly around, let's say, 2010, and they made a decision that they wouldn't, in fact, pursue criminal charges against certain bankers. And in fact, certain members of the previous administration said, what can we do for you? That would not bode politically. And people felt that. People felt that there would be repercussions for that action and non-action. But tell us, there's some wonderful insights in this book where you're in these wonderful places reporting what you're finding. How did you get access to those places?
Through a really variety of sources. When I'm in a place, I tend to sort of scrounge around. So I will talk to small business owners, I will talk to students, I will generally have a university professor say, yeah, it'd be a good idea if you come and visit us, and I sort of have dialogue on the academic levels as well, and with the students who are going through those areas. I mean, that happened in Brazil, actually. I was in a town called Porto Alegre, which is where there were a lot of demonstrations. It's where Dilma Rousseff actually got her doctorate in economics, and so there was a lot of sort of feelings in the streets, and massive amounts of people when I was there, and so I got to talk to a lot of those people. Unfortunately, some of the students knew both English and Portuguese, which I do not know, and they were able to navigate me through that. In terms of the people at like the IMF or some of the central banks, some of those came from contacts in academia who had come from ministries of finance and so forth. Some came from outreach. Some came from people I had interviewed or spoken with in the past. Some were reach outs. It was really, this book is really a culmination of so many of sort of my experiences and contacts over the years. I started life as a banker, basically, and got sent to China when I was, when I first started at Lehman Brothers as a whole other story, but basically to sell some stuff into the Chinese Central Bank, the People's Bank of China, back a while ago. And I sort of circled back there this time around in, obviously an entirely different world with entirely different knowledge, and finance has changed and everything has changed. So I think I was able to just get, as I do with books, a lot of, and as we do as journalists, a lot of different connections into different parts of society and sort of past government and everything else. And also as journalists, I think I don't say everybody's name in the book. Obviously I keep the trust that people have in journalism intact, and piece the story with publicly available information where I need to, as we do. So it's a real combination of many connections throughout the years, and that I made new.
Yeah, and you have this beautiful phrase in the book called the dangerous new normal. What's your prognosis for our economy and the global economy, not that they're mutually exclusive, over the next 2 years?
So I think that the quantitative easing, the low rates, this sort of manufacturing money to stave away any sort of instability in the stock market in particular, because that's just sort of the quickest indicator to the public because of how the media portrays it, and to regulators and sort of politicians. It's just an easy sort of figure. If it's going nuts, if it's dropping 1,000 points in a day or 500 points in a day, it's generally a sign to central bankers that they might have overstepped something. And they don't say this publicly, but then all of a sudden you'll see something else happen in another part of the world that sort of evens things out, and then the market will pop up again. And I think that process is sort of sputtering right now. So there's more sort of movement in that indicator to them in the stock market, and I think that's a sign that things could be coming to an end. But the bigger, in terms of this headiness, the sort of—
What do you mean? Which things coming to an end?
When I think the ability of central banks to sort of conjure money and keep rates. There's only so low you can keep rates. I mean, you're zero or slightly negative. You can't really go much below slightly negative. We thought they could go negative, but that happened. And so there's not a lot of ammunition there. There's some people like me who think that the Federal Reserve, for example, having raised rates a little bit, sort of led out of this 0% money throughout the world, is trying to do things around the edges, like sort of roll back the possibility of their forecast being correct, which is 3 interest rate rises this year. It might or might not be correct, but they're sort of rethinking the effect of moving rates up. And that reason for that is because it creates, creates just anxiety in the market, not because of what it does to the economy or people. But the bigger thing that could go wrong is the amount of debt that has been accumulated both in our country and throughout the world, in corporations, in governments, that has been issued because rates have been so low, so therefore it's been so cheap to borrow from the future and not really pay much back for potentially ever. This is one of the things, for example, Japan did. They have these sort of perpetual bonds where it's like we can effectively borrow into forever as long as we keep rates low enough. And I think the problem with that for, say, corporations and even individuals is that at some point you have to pay back something. So if rates go back even a little bit, you still have to wind up paying them back. And if rates go up more than a little bit, then you have a global problem. Today, the amount of debt in the world relative to GDP in the world is 225%. So more than twice as much debt exists, and much of that has accumulated since the financial crisis relative to the sort of economic production of the entire world. And so that's a lot of debt to be operating under. In addition, individuals are at their limits or reaching limits of credit card debt, of student loan debt, of auto debt, not so much mortgages because that kind of had a little bit of a wipeout 10 years ago, but really living on the edge of a system which also creates political anxiety and everything else that also can't continue to hold forever. So in 2 years from now, I would think that's a good potential time for another financial crisis, which will start with some of this debt defaulting as it does, whether it's emerging market debt or whether it's corporate debt in developing countries, or just rates being lifted too high too quickly that causes companies and countries to have to repay too quickly with money they don't have because their economy didn't really grow and they can't really sustain it. And I think that bubble can then pop very, very quickly. And in the stock market, we've seen it already sort of do a lot of sort of ups and downs in this year. But also when debt starts to not be repayable, then there's no money to keep stocks up, and therefore the stock market starts to go down even more quickly, as we saw in the financial crisis of 2008. So I think right now they're sort of the major central banks in a kind of a trying to be in a holding pattern. But I think that has an end.
Quickly going back to that comment you just made about 2008, on many levels, you talk to people who may not care to understand or don't understand all the technicalities of what you've just described, but there is, and you can't even overstate it by calling it an apocalyptic sense that you do not know what the future holds in terms of retirement, in terms of feeding yourself, and you see all kinds of examples of this, people saying, the economy does not feel like it did before the crisis, and many Americans say that we haven't recovered since the crisis. And I found myself talking to a guy called Nigel Lawson, who was in many ways an economic brainchild of Thatcherism. He was Thatcher's basically Secretary of the Treasury at the time. And almost crowing, he said that the failure to deal properly with the financial crisis in 2008 really did the left in a meaningful way. So winding down, I think we'll ask 2 more questions and then get to the audience. And what thinking about that in terms of a global rightward shift, among many reasons, is not the only reason.
Well, I think that's right. What happened was here in this country with the election of Trump, in the vote of Brexit in the UK, and sort of the shifting to the right, or sort of a more fascist type of rhetoric throughout Europe and in Brazil and so forth, is that when people, and it's kind of like the song, it's like, you can only blame sort of others so much, but it's not necessarily going to change your economic situation, particularly when the inequality that you're experiencing, that you're feeling, that anxiety, it's real. The money is going to, and not even just money, like a lot of money, trillions of dollars that then get leveraged or that banks and other institutions can borrow against to create sort of more money, is going into the financial assets at the top, and it's going in of the sort of financial hierarchy. And so the feeling that it's uncomfortable and that we haven't really recovered anywhere. And the financial crisis that happened in the United States hurt the rest of the world. I mean, what the rest of the world is experiencing in many ways is still a result of our financial crisis, and all of these shifts are a result of that. I'll give you just a real-life example of what you're saying, because my hair is important to me. Okay, it just is. And I was, and what I do before I go, do one of these things or get in front of people or whatever, is I tend to make sure it looks okay. I'm not going to ask you what you think of my hair, but I was talking to a hairdresser and who was doing my hair, and he was new to me, so it was the first time I'm really having a conversation with him. But I'm telling him about the book tour and the book and everything else, and he says, I've really struggled with, since the financial crisis, of where I keep my rates for things like a haircut, things like a blowout, things like color. And because I struggle, I don't want to raise them too much, but my rent's raised a lot. The rent on this chair is raised a lot. But if I raise rates too much on my services, I could lose customers. I can't afford to lose customers, so I have to keep them at a certain level in order to maintain a certain level of clientele I have, which means more of a cost to me. And then it goes down the line, because he's got to pay for product, he's got to pay for shampoo and color and all sorts of things down the line. And the people that supply or create those are now selling less because people are paying less, and because there's only so much that these are small business owners can afford to sort of be out during these entire processes. So he was basically saying everyone down the line, from the people that only come in once a month instead of once every 3 weeks, to him having to keep his prices the same, to his rent going up, to the cost of his product going up, but him ordering less because of that, which then hits the product providers. All of that, he feels, as he was doing my hair, was a direct manifestation of the financial crisis. And that cycle, it's something that the Fed knows. The Federal Reserve does these inequality studies every 3 years, and they themselves had their last report in 2016. There'll be another one in 2019, say that inequality has grown since their solution to the financial crisis. They know this. But it's these little things along the way that actually dampen the sort of economic spirit of people and create that anxiety, as well as the real, extreme expenses like health insurance premiums, like student loans taken out for universities and so forth.
Nomi, I go to a different hairdresser than you. Nonetheless, my barber is working 3 jobs. His hustle's got hustles. And it's that sense that there's no longer a one-to-one ratio of your hard work and your productivity to what you get on the other end, and trying to figure out in the new numbers, the new indices of what an economy looks like no longer hold. And I think that's part of the anxiety that I hear about. So final question from me, and then I'd love to hear from the audience. If you could make anybody read this book, really get in all your wonderful research, your travels, what you've overheard, what you've learned as a whistleblower, what you've learned as a refugee of Goldman Sachs, all that experience from both working in banking, which I'm sure you miss, to being an investigative journalist, who would that person be? Who would those people be that you could make read this book?
Well, I dedicate my book to the citizens of the world. I did do that, so I do hope that parts of it are widely read by people who are impacted by something they can't quite, sort of understand or quantify. I think in terms of the people that run these institutions, it would be good right now if the head of the Fed would take a little, sort of peek at the book. And in fact, we should send him a copy to Jerome Powell, who's the Trump appointee to the head of the Fed. I should mention that the presidents are the one who appoint the heads of the Federal Federal Reserve in our country, and that Congress is supposed to reject or accept that person, and Congress has always accepted that person. So the relationship, even though it's supposed to be independent, is fairly political, even though they will swear against it. I think Trump should read it. I do.
He doesn't read
I doesn't, and that's the thing. So I think someone could, put it into notes or tweets. We could tweet the book.
Volunteers. We're taking volunteers. But seriously,
yeah.
to put it in a graph, to put it in a book, to see concretely what the collusion you're describing has on people's pocketbooks, on the country's prospects, I think that's a great idea.
Thank you.
Yeah. Okay. How much time do we have for questions? Okay. Questions, please.
So earlier you were talking about this private meeting with the central bankers. And that reminds me of some comments you've made in other interviews where you said it took all the genius and expertise of these mid-level bureaucrats to come up with quantitative easing. And when they did it, they ran out of ideas. They don't know how to unwind it. They don't know how to come up with any alternatives. Didn't they study the New Deal? I mean, Henry Morgenthau and FDR came up with a government-initiated program. They funded it, and it put a lot of people to work. And it mobilized the nation to get ready for World War II, really, which then shot us through the roof economically. So they have no institutional memory? What's wrong with these people?
Well, what's interesting is the person who started quantitative easing here. It actually started in Japan, but on a way smaller basis years before that for a banking crisis over there. But was Ben Bernanke, who professed to be a depression scholar. And you've probably heard me say, I don't see how you can study the sort of crash and the regulations that were put in place on banks after the crash, the Glass-Steagall Act, and what FDR did in terms of jobs and other types of programs, and come to the conclusion that what the Federal Reserve has done this time around is actually found useful to the real economy. So yes, that's a problem. Like, they don't have an unwind. I've actually, they could do things right now that they didn't think of, during this 10-year period. That they could actually take, the Fed has $4.5 trillion worth of assets on its book, which it purchased from effectively banks for effectively nothing. And that's money that could be used as collateral for infrastructure building. I mean, there's no reason why we couldn't have a national bank or an infrastructure bank or a development bank like most countries have, and plenish it with debt that's already been created and money that's already been conjured, therefore, to create this pool of debt, instead of being an asset manager like a hedge fund in the middle of Washington, D.C., to actually divert that money into something of real lasting benefit. To an extent, that's what China has done during these 10 years. They're very critical of the financial speculation of our system and what the Fed did in terms of rewarding the banks as opposed to breaking them up or beating them back. And they've used their version of quantitative easing to form more trade alliances with partners throughout the region in Asia, with Latin America, people and companies in Brazil, Mexico, and so forth. And they've used that money to actually build things. And green energy projects and things that actually have some sort of lasting use.
And in other continents like Africa and stuff.
Yes.
Yeah.
Okay, next question.
I became interested in this subject pretty anecdotally with a fight with Citibank over my MasterCard, where, I was just living my life, and there was a little bit of a tight time, so I was paying, regular payments. And then suddenly I was late, didn't pay, I just didn't arrive on time. And my rate went from like 11 to 28%. And I called him up and I said, there's a guy down the street named Louis. He does 28%. It's like, are you
He
guys
chops
wrong?
off your fingers.
Yeah, he chops off your fingers, but he said he'd do it for 26. And it started this fight, and I just wouldn't let it go. And then after the financial crisis, of course, I realized that now they owed me like $100 billion. So the tables turned. And then I started following and digging in. And I guess my question to you is, one of the things that I noticed is that the Goldman Sachs type institutions wherever they go internationally, when the crisis happened, their fingerprints were there. Iceland, Ireland, Portugal, Greece. And so they kind of get you going in, and then they get you going out. They say, oh, how can we help you get out of your horrible debt? Well, it's going to cost you, but we'll work with you. Is that crazy?
No, that's very real. I mean, the private banks, it goes back to the question, why aren't Wall Street banks helping Main Street more with the most recent dump of capital they now have from the central bank, from the Fed in particular. And yes, they can increase, as many of you may have seen as well, credit card rates, just like that. It is in the fine print. You know, you can read that like multi-page thing that no one reads when you but this is a thing that happens, and it is a way to extract money generally from the people who least have it. And in recent history, where their money is coming to them at effectively 0%, that's a pretty big spread. In terms of those countries that you mentioned, and in general, the Latin American crisis back in the day, what will probably happen in another crisis if rates raise and the debt that's been extended over these years defaults, is that what banks do, they look, and this happened when I was in banking, you look for sort of the weakest areas because those are the ones that you can make the most money from. So if you're looking at, if there is a company or a country that has a problem, they're generally in a situation where they'll accept any help you can give them. And so whether that's restructuring that debt with a large attached cost to it, or whether that's sort of restructuring, like in the case of Greece, debt such that Greece can become part of the EU, and then later the EU saying, well, you know what, you guys are a bunch of deadbeats, so we're going to basically steal all your ports and make you pay for it because all you do is not work and like pay pensioners, which is not true. But that was basically the sort of story that was told. But what had happened was bankers had been there first. They'll probably be back. Because you just make more money out of spread. You make more money when there's more uncertainty in the company that you're working with, or the individual you're working with, or the structure, the building that you're working with, and you can take it and buy it cheaply and sort of sell it out or rejigger it in some manner more expensively. And that's how you live. I mean, in the last 10 years, you've had this additional sort of cheap money coming in from the central banks throughout the world, so it's added on to that. But this is how you operate. You operate on spread. You operate on fees to restructure, and you always get more in the most precarious situation.
First off, I recently read your last 2 books. They were like masterfully written. They're phenomenal. So my question is this, because I follow James Rickards a lot as well. If the SDR replaces the dollar as a reserve currency, what does America look like when we can no longer rely on like cheap imports and all the benefits we get from being the reserve currency?
Okay, so that's a question with a lot of components. So basically, in general, when countries trade with each other, the weaker or the cheaper one currency is, the easier it is for them to attract buyers for their products, right? It's just easier for someone to buy something that's cheaper. And so if the dollar is cheaper, then goods that we create in the United States become cheaper to other countries. And that's this idea of depressing the dollar. That's sort of sideways, but just because you mentioned the SDR is this thing, it's called the Special Drawing Rights Basket. And it's another wonky acronym, but it's basically, it's sort of an average of the major currencies that are used for global trade in the world, of which it used to be the dollar, the euro that replaced the French franc and the German Deutschmark, the Japanese yen, and the UK pound. And so now what is in it is the Chinese yuan. So one of the things that happened in this sort of China growth story, and this out of the ashes of criticizing what the US and Fed have done for the financial system here, is that we've added on sort of this other currency into the SDR. And the idea of that, which is actually a surprising thing from the book, it's very wonky, but really the current head of the IMF, Christine Lagarde, is had a very good relationship with the former head of the People's Bank of China, Governor Zhao, and they said a lot of nice things to each other publicly, but she also let and pushed for this extra currency outside of the core currencies to come into the SDR. And there was all this fear that would devalue the dollar, because all of a sudden you have the same pie, but you have different currencies competing for the pie of trade in the world, and therefore, by definition, anything that was there before is now replaced by the new currency, and it depreciates. It has less value because there's more going around. It hasn't really happened yet. And the reason it hasn't happened yet is because the dollar has been, regardless of our policies, regardless of the Fed bailing out banks, and regardless of it tanking the financial system by not regulating our banks properly and exporting that as a main good of the United States, hasn't yet lost the grip on the dollar being the reserve currency of choice for the rest of the world's central banks. So whenever there's a problem, it's dollars that fix it. That's part of the collusion here that happened at the beginning of the crisis. Dollars fix it. So at some point, when countries trade more and more with each other, and they trade outside of a system that's predicated on the dollar will weaken by default. And that's what was put in play by the Chinese currency being part of the basket. And if the basket gets used in more trading and grows as just sort of a kind of composite currency, it will also, by definition, devalue the dollar. I think it will happen over a longer period of time because a lot of things are moving in that direction, but it's a world. And it will just take, I think it's shifting towards that, but I don't think it's a tomorrow thing. I think it's a shifting thing. The dollar's been depreciating the last few years, but it's relative to those currencies, but it's going to take time.
Let's do 2 more questions.
In the 30s, the New Deal worked for a while, and then private businesses got really pissed that I'm talking about the investment part of the New Deal, not the financial regulation part of the New Deal, but the investment part of it, private capital got really angry because they wanted, and they tried to stop the things that FDR was trying to do, and it wasn't until, and then things, the Great Depression was continuing on, and it wasn't until World War II, and all of the money on defense, quote unquote defense, or on military spending, that got us out of the Great Depression. So I guess I think things are worse now than they were then in terms of in terms of capitalism having infiltrated more of the world than it had at that point. And for it seems that the reason why all these banks are like doing stock buybacks and mergers and all that stuff is that they're not seeing any way of making profits out of doing real things. So I guess I see it as like not just the financial system, but capitalism, like a system based on where everybody's trying to make more money than the next person, which leads to the inequality that makes it well, like even if they did do investment, who's going to buy it?
Let's ask a question so we get more people in the audience.
Okay, so I'm interested in how you see Main Street fitting in with it. I mean, do you see it just as a problem of the Fed and of the banks, or do you see it? How do you see the relationship?
Well, from the standpoint of Main Street versus the banks, again, when you help the financial system by giving it money, or in the case of what happened at the beginning of the New Deal, it was to create confidence in a system that had broken and during a depression. So there were things that were done to help the capitalists, to help the banks, to help sort of the upper echelons of society. At the time, bankers originally agreed with the New Deal elements that regulated banks. They agreed with Glass-Steagall. They agreed with separating deposits and loans from their more speculative activities and having the government guarantee those deposits because it benefited them, because otherwise no one was going to put their money with these banks. I mean, there was a complete lack of confidence this time around. And then after that, as you say, Ruthie, they ultimately then were negative on other elements of the New Deal. It said, okay, well, now that we've got this sorted and regulated, we need to actually spend money on developing the country. And they had more of a problem with that because at that point they were doing a little bit better, right? They had the help. They're like, thanks. Now we need to not have that anymore. They don't like restrictions. So this time around, same thing. They had this epic pile of money made available to them, used to purchase assets they had no other market for at a time when they needed to get them off of their books, and the Fed and other central banks came along to do that, and they took it with no strings attached, and that saved this element of capitalism, that saved our financial system in the narrative. It did not save the general economy because it didn't implement a real development or infrastructure or jobs program. And so it's really more fictitious, which is why at this point in capitalism, in our history, in the world, it's really more of a precarious position for Main Street than it was back then. And then it was like an acute depression, and now it's sort of this slow burn. And that's what makes it so much more dangerous this time around.
Can I ask one question and then we'll... How do you think Bitcoin and other alternative currencies will affect the central banks?
So in terms of Bitcoin and other cryptocurrencies, I go back to Christine Lagarde actually, and a quote I took from her in the last chapter of the book, and she, not only in her position at the IMF, sort of invited China and other developing countries to have a little bit more of a seat at the table. There's issues with that. That's like a whole other thing. But just sort of changed things from the post-World War II status quo. She also talked about how at some point cryptocurrencies, digital currencies, were going to become a real factor in terms of how central banks should operate, and that they couldn't sort of ignore them. Now, there's some people that would say, well, that's because central banks want to control cryptocurrencies, and there is an extent to which they want to control all of the currency transactions, because you can't, for example, create money for the private banking system if most of the trade or most of the individuals aren't banking with the public banking system, the private banking system. They're doing all their transactions in crypto. So you can't really have that same power over control or rigging of the system if you are losing that percentage-wise to cryptocurrencies. That said, I do believe that there's a lot of problems with certain cryptocurrencies, and I personally think that I don't want to sort of, I wasn't a big Bitcoin investor. I didn't sort of advocate Bitcoin, and the reason for that was I don't think it's mature enough to handle its own crashes. And so just like anything else that comes along in a system, you don't want to be that person who, sort of sells the farm to get the Bitcoin, and then the Bitcoin crashes as it did from January to now, from like 20,000 to wherever it is today. Does anybody? Right. And you lose 50% of money you really needed. So I think there is a need for any kind of cryptocurrency to really be a strong alternative, a solid alternative currency, to also have safety mechanisms in it, and sort of a way for people not to have to consider a 50% sort of gain or loss, especially if you're a merchant or you're a small business, you're an individual, and using it for payments of your bills in any given month. It has to reach a point of stability. Maybe that's when there's more use, maybe when that's a few regulations or rules involved that allow recourse to people that have used it so they don't necessarily lose money. And of course, you're always going to have speculators in any new market, so it will take time for that sort of equilibrium of speculators versus end users in that alternative currency. But I do think it would be great if there was one that actually had safety mechanisms in it and that could act as an alternative to the central banking system.
It's called FedCoin. But it's not
FedCoin.
I think of wine coin, but
Yeah, so this is around the corner. I mean, there are already people trying to start cryptocurrency merchant banks that will deal in international coin offerings, totally independent of what's going on in the quote-unquote real currency market. So this is around the corner. Instead of doing the last question, I'll let someone take the last question, and then we'll call it a wrap. Yeah.
You said we're 2 years away from a crisis. You said we're 2 years away from a crisis. So can you sort of lay that out? And what it might mean for November of 2020?
Because people want to leave on a happy note.
right. We'll put the music back on, but that's not. No, the reason is because there is still this sort of dance between central banks that allows one in one area to sort of defend a market in another area and sort of keep the party going in terms of cheap money, in terms of quantitative easing. Europe just extended its quantitative easing program. At some point, and there will be a shift, generally in 2019, this is the head of the central bank in the United Kingdom, the ECB, and so forth. There'll be a little bit of a shifting of the guard, and that could create an issue if they want to sort of do the unwind. I think that the problem with all of this central bank money and low rates and quantitative easing is the unwind done improperly could be very ugly. If you start to dump all of these assets into the market, it sort of depreciates all of this debt value. It depreciates the stock market immediately, and that wiggles into pensions, that wiggles into companies now not feeling they're as valuable as they were and firing people, and a lot of other things happen. So I think we're kind of at a sort of a more precarious kind of dance, but the dance is still happening. So that's why I say a year or 2 years. I said this, though, last summer because I thought that the European Central Bank would actually do what they said. I don't know why, I should read my own stuff, and stop their quantitative easing program when they said they were going to stop it, and then an abrupt shift in one of the sort of three major economic regions would actually sort of kickstart a potential crisis. Well, maybe they read my stuff, but they decided not to do that. So I think there's still, it's like the cards, they're still putting in cards at the bottom of the sort of card castle to try and solidify it, but it's still a castle of cards.
The second part of the question, if it does come to a crisis within the next 2 years, what do you think it means in November 2020?
Well, I think if we actually have a crisis in 2020, it's going to look pretty much that the sort of happy stock market promises that were made to the general economy. In other words, I lifted the stock market. This has all happened since me under Trump. Will look a little bit less connected to Trump. I mean, I don't think it's a little bit connected to Trump now because of the tax cuts. I mean, there is extra money now coming to these companies that they didn't have. So it's like you had QE 1, 2, and 3 in the States, and now it's QE 4, the tax cuts, but that's just sort of the cherry on top of their cake that way. I think that whoever is it could help shift the election in 2020 away from Trump to whoever might be running on the Democratic side. But that person, whoever that is, really has to get their act together. They really have to understand. They have to read. They should read. Whoever runs for office should read my book because there is a problem that fundamentally economic anxiety is based on real factors. They're based on factors of money being given to one group at the top, like given. This isn't even like they made it and took it. This is like it was provided. And it hasn't infiltrated the rest of the economy. So there's already all of those feelings. So if we also have a stock market crash on top of that, whoever is campaigning at the time had better understand why it happened, and it wouldn't have been just because of Trump and who was president at the time. It doesn't matter who's president at the time. What matters is doing something about regulating the banking system, about having the Fed actually do something that's diversion for its money into the real economy, or doing anything that actually creates more stability so we don't have another crash after the next crash.
Okay, first and foremost, I would like to thank the audience for coming. And Nomi, thank you for writing this book and for being such a truth teller to power. And thank you to the Strand for hosting us in this lovely space.
And thank you to Rich for doing this again. You did this in my last book here as well, so I appreciate all of what you do.